We're seeing a lot of involuntary debt liquidation. And we've got so many areas out there where we talk about the leverage and we talk about, mentioned the numbers on debt and derivatives, but it's also look at what that means. It means all that private equity that's basically leveraged buyouts. All the pension funds that have loaded up on private equity because it didn't have the volatility that the market had. You've got a lot of those things that have kind of come into play in this cycle and have never really been fully tested. So I think you're going to see, a very violent unwind that, I think the bear could go from peak to trough in 8 to 10 months. As I said, I think the economy can go, the bust could be over in 12 to 18 months. So it's not that it's going to be long lasting, but while we're in it, it's going to feel like an eternity.
It's hard to identify what might be the sort of hair that breaks the camel's back, right? In these scenarios, when everybody is so leveraged and every country is so leveraged, it could be any number of things that is the first domino, causing a tiny liquidity squeeze over here, which causes a bigger liquidity squeeze over there, and then it permeates, right? And that's how these events occur. And so to recap, it's only a matter of time before somebody defaults in some fashion, right? And that's the first domino. That triggers the recession. We expect 8 to 10 months peak to trough after 30% rise of the equity market from today forward. There's still going to be a frothy blow off top, as you mentioned, but eventually bills are going to have to get paid. Deleveraging will begin to occur. And over the course of nearly a year, 8 to 10 months, you expect that's potentially up to 80% correction in the market. Now, the Fed's going to watch this. You believe they're going to be more conservative than they've been in 2008 and 2020. So they're not going to just roll out 10 trillion in stimulus.
Yeah, that's actually, I'd say that's probably the easiest prediction I can make.
Okay, interesting.
It's human behavior. You're looking at, they got criticized, not just Powell, but all the Bernanke before him. Yeah. They got criticized for all the the ZIRP policy and all the money that was printed. And so they're not going to go back there, or at least they don't think they're going back there.
They don't think they're going to.
If given truth serum, he's being very sincere when he says we're not doing that again. But that's easy to say when you're not in the midst of it. When you're in the midst of it, there is only one tool that they can deploy. Mm-hmm. Nothing else. You can't do it through Congress. You can't do it anywhere else. Money, it's happening so fast. The only thing that can help stabilize things is just printing gobs of money.
Yeah. So the search will be for the right-sized policy, as you mentioned. And I wonder, that I love that you said that. That's your easiest prediction, is that the Fed will not respond aggressively right away. They're going to try really hard not to. And immediately my thoughts went to Reagan taking office, right, with bold plans to clean up the government balance sheet. But once he got to office, realized how much harder that was going to be. I think about President Trump's first term, right? Promises of draining the swamp. But once you're in the swamp, turns out it's a lot harder, right, when you're in that Oval Office. And it's hard to deliver on those promises. And maybe you're faced with new realities you didn't understand previous to taking that seat, whatever it is. But I found myself wondering, is that, Powell can say one thing today, but in the heat of a 2008 style recession, everything's different. And whatever you thought you might do just doesn't hold up anymore.
Yeah, because right now the worry is if we go back there, we could trigger inflation and make our job so much harder. They're not understanding, and I've said this too, is I don't think there's anybody in the FOMC or anybody in the Fed, frankly, that really understands the magnitude of the risks this time around. Like I said, it's really that debt and derivative story that because leverage can have things happen much faster. And then when you have that kind of leverage, that magnitude of leverage, it can make things so much greater. I don't think anybody's thought through that and understands. I think they think 2008-9 was a one-off, and that, yes, we have risk that it could be something like that, but less. but I don't think anybody's really understanding how close we are to something bigger than 2008-9. And so if it's not even in their mind as a possibility, it's not among their scenarios. They're thinking the risks. He says this all the time. Risks are balanced. We have to worry about tipping us into recession versus worrying about inflation breaking out a bit. You have no idea. That's the least of your worries. It's so much bigger than that. And he's not going to, certainly in the next several months, he's not going to understand because the markets are going to be looking like things are okay. And frankly, Powell gets a lot of heat, and I defend him on some of this only because I think people have to step away and realize he's saying the same things that the vast majority of Wall Street economists are saying. They weren't pushing for rate cuts here either. I think Powell is late. I think the Fed is late. They should be easing now. But he's not the only one thinking that they don't need to ease. There's no rush. Things look okay to most Wall Street economists. And yet we may be just months away from something that ultimately becomes much bigger than anything we've ever seen on the downside.
And so eventually, and it probably won't be Powell, I suppose, in the seat at this time if it's 18 months into the future. Will have rotated the Fed chair at that point in time?
Yeah, and I get timing off all the time. These are big cycles, and I can be wrong by many, many months. But if I'm right about my guess of when this thing really gets going, it's probably first quarter next year.
Okay.
So he'll be dealing with it before he leaves his position, I think, assuming he sticks around for that. But yeah, then he'll be handing it off to somebody else, and the biggest part of the money print will be probably under somebody else's leadership,
which is convenient, right? That allows Powell to deliver sort of on his mandate and leave the seat as the guy who did what he said he was going to do or didn't do what he said he wasn't going to do. And the new chair can then inject this $20 trillion stimulus that you mentioned. So running that forward, that puts us in a sort of new monetary world, does it not? A $30 trillion balance sheet. Rates have to be zero at this point for any.
Right.
There's no other way around that interest expense. Rates have to be zero, and we're in total sort of monetary dominance. What's that? Any thoughts on that, David? What does that look like, and what's the cycle there? I mean, obviously, my audience is probably like, "That's fiscal dominance. This is the downward spiral and the absolute destruction of the purchasing power of the U.S. dollar." But what's your take on it?
Yeah, so keep in mind, the U.S. is not operating and the Fed's not operating in a vacuum here. It will be proportionally the same story with every central bank. This is a global bust. They'll all be printing at breakneck speed once they realize they have no choice. Again, I think that it's not just Powell. All the central bankers, to one degree or another, are going to be cautious about printing. So they're all going to be behind the curve for a while, and ultimately then have to really race to catch up, and that's when the money starts pouring out. But it's still ultimately the story of all that money. Let's say it's 100 trillion. I don't know what it's 50 trillion. Is way beyond anything this world has ever seen by magnitudes. The story is that it jumpstarts a recovery for sure, but it also jumpstarts inflation. Now, I think the bust will be deflationary because we're going to be entering the bust at low single digit inflation. So I think we probably almost definitely go into deflation for a year. And then coming out of that means the first year out, despite all that money, you're probably in low single digit inflation. Second year, maybe high single digit inflation. By the third year, you're in double digit inflation on your way to, I think in the US, you could see 25% inflation by early 2030s. So, I mean, the ramifications are huge because rates follow inflation. So if we're going to be looking at, I was a money manager in the early 80s. So, you're looking at interest rates going from zero, I'll just talk the 10-year. Short rates could be negative, or most likely going to be negative, but you go 10 years zero, and within say 6-7 years, you're looking at 10-year maybe approaching 20%, and maybe in less time than that even. So we're still going to have the debt. We're still going to have governments having to finance, having to service their debt. And my guess is, I talk about the money, but it's going to be both fiscal and monetary. Obviously, it always is. The Fed will be monetizing new debt. The Treasury will be issuing new debt. They'll be doing all kinds of programs like they did in 2020, and so the Fed will be buying all that debt, monetizing that debt. That means if we're at 37 trillion now in U.S. government debt, it's probably going to be north of 50. If we're at 330 trillion now, global debt, both sovereign and private, corporate, everything, it's probably going to be something approaching 450 to 500 trillion. All that debt, or a lot of that debt's going to have to be serviced and refunded, refinanced, et cetera, at higher rates. And, just sticking to the U.S. government, there's no way you can solve that equation if you're looking at interest rates in the double digits and your debt is where it is. We can't service it at 5%, right?
No.
And it crowds out every other thing you can do in the government if you have to. That ultimately, I think it leads to, again, not for several years, but probably by 2033 to 35, I think it leads to a collapse of the financial system as we know it. The Austrians might believe, if I look at Peter Schiff as an example, might believe that this is the end game now, and that that we're heading straight south from here. I believe that we have one more cycle because we have the printing press. As long as you have inflation near zero or below zero, you can print money almost to infinity because there's a lag to when that shows up as inflation. So for the next, when the bust hits, for the next 18 months after that, you have the ability to print money to whatever level you need to. And that's why it's going to grow to what it is, because they're trying to stabilize the system.
Yeah.
But then once it happens, there's nothing you can do because you've waited way too long to back off of that. And once that inflation starts heating up, you're not going to be able to stop it. They're going to fight tightening because tightening means higher rates at a time when they can't afford the rates that they're going to be dealing with. So they're going to be slow to tighten. And as I say, you can't print your way out of it once inflation really heats up, because it's like pouring gasoline on a forest fire. It just makes more inflation. So they run out of options next cycle. This cycle, they have the printing press. Next cycle, there will be no options left.